So welcome back. Now we shall take one of the simple strategy. Of course, we are discussing the advanced options trading strategies, but within those advanced, we will begin with the simpler one and gradually we will build upon it. All right. So the most simple strategy among the advanced one is a straddle. That strategy is called as a straddle. What exactly is a straddle? We have discussed this straddle earlier in the previous section, but we had not discussed the logic of the straddle. Here I will try to explain to you the logic. So what exactly is a straddle? Look at this picture. This is a straddle. It is put on a horse's back and then you sit on it with your legs on either side. You don't put both your legs on one side, you put your leg on either side. Now it may appear very simple, but please listen to this lesson very patiently, very slowly. You may find little difficult to understand, but if your concepts are clear, it may not be very difficult. Alright. Let us say that a stock is trading or an option is trading in the market at these strike prices. Alright. Don't worry about the figures. The figures are just to make you understand that 100 is more than 80 and 60 is less than 80. That is all. They are all relative. Let us say that you go short on a call and a put. That means you sell a call and you also sell a put of the same strike price and the same expiry date. So what you do, if 100 is at the money price, you sell an ATM call, and because you are selling, you receive a premium of $5 or rupees or whatever, and don't worry about the figure. It could be 5, it could be 7, it could be 500, depending on the option and the time you are trading. All right, the figures are just to make you understand. And you simultaneously sell an ATM put, so a call as well as a put of the same strike you are selling, and then you receive a premium of $10. So what have you done? You have put one leg on call, one leg on put, and you remain exactly in the center. So this is the payoff diagram of a saddle. All right. As long as you remain in the center, you are safe. You are in profit. But if you tilt too much on either side, you will lose and fall off. Let us try and understand that. All right. Now, if the market remains stable at 100, then you gain maximum on your short call and your short put because you have sold, isn't it? So if the market does not move, you will retain that premium. You will gain the maximum. But if the market moves towards 90, if it starts moving on the left here, then you will gain on your call. Because you have gone short, you will gain on the call, but you will lose on the put. If the price is going down and if you have sold the put, you will lose on the put. And similarly, if the market is moving towards the right, if it is moving towards 110, then you will gain on the put. But because you have sold the call, you will start losing on the put. I hope your concepts are clear. You have understood the previous lessons. Alright. So what will happen? You will remain in net profit as long as you are in the green zone. That is between 90 and 100. The moment you go on either side, you will start losing. At 90 or at 110, if the market expires, you will just break even. But if the price falls below 90, you will start losing. Even if it goes above 110, you will start losing. And your losses can be unlimited. The more it goes down or the more it goes up, you will lose more. Alright. Your maximum profit is limited to the premium that you have taken in this case because you have gone short. You have sold the call and the put. So you have taken the premium. Whatever premium you have taken the maximum, that is your maximum profit. But your loss can be unlimited. If the price keep rising or keep falling, then your losses can be unlimited. But if the market remains stable, again, your profit will be high if it remains stable. So you have seen that because you have gone short on both the legs, That is why it is called as a short straddle. Got it? It looks like a straddle first of all, but why short? Because you have gone short on the call and put. And the short straddle is good for a stable market or a sideways market. If the market becomes volatile, then you start losing. Have you understood very clearly? If yes, then we now try and understand the long straddle, the opposite of that. Let us consider the same. Now, earlier you had sold, now you will buy. You buy a call option and you buy a put option of the same strike price, the same expiry date. So what you do? You buy an ATM call at a strike of 100. Earlier you had taken the premium, so now you will pay the premium of the same 5. Again you buy an ATM put, again you pay the premium. So a total premium of 10 you have paid because you are going long. Alright. So what have you done? One leg on either side you have put, but you have gone long. You have bought. So the straddle becomes inverted. Alright. Let us try and understand it now. See, if the market remains stable at 100, if the market does not move, then what happens? If the market does not move, then what happens? Your call and the put will start decaying and you will start incurring the losses. Your maximum loss will be the amount of premium that you have paid, nothing more than that. You will benefit only if the market gets volatile. Either it goes below 90 or above 90, or above 110. If that happens, then you get into the green zone. You start profiting on either side. If the market expires exactly at 90 or 110, if your option expires at these figures, then you will just break even. No profit, no loss. Alright. The more it goes below 90, you will gain. The more it goes above 110, again you will gain. Between that, you are in a loss. Alright. Your maximum loss is limited to the premium that you have paid. In the earlier case, when you had gone short, you had taken the premium. Here you have paid the premium, and that is your maximum loss. But if it happens to be a profit, that profit could be anything. It could be unlimited, depending upon how low the price can go or how high the price can go. You will benefit from that. All right. But if you are greedy, if the price goes lower or if it goes higher and you still don't get out of your situation, and suppose if the price comes back to 100 at the time of expiry, again you will be in a loss. Got it? Because you have gone long here, it is called as a long straddle. In the earlier case, you had gone short, so it was called as a short straddle. Long straddle is good for a volatile market. In the previous case, the short straddle was good for a stable or a range bound market. I hope you understand that. This straddle, understanding the straddle, I hope it was very simple. This is the payoff diagram. Alright. And as I said earlier, don't worry about the price figure. Just try and understand the concept. What is a straddle and how it is a short straddle and a long straddle. Alright.